Thank you.
It doesn't matter.
Right. That's right. Turn down 2. You got a sec offer, give me a mic check.
2.5 minutes, test. Good afternoon, everyone. Come on in, water's warm, ask us questions. Anything goes, not anything, but for now, close to anything. Risk radar all yellow. Brent Kochuba, quote of the week, we are all oil derivatives traders now. Coming up, 2-minute drill. Oh, I never uploaded my TikTok.
Lucas Graham.
Oh, I did. Yes, I got my TikTok in earlier.
Well, whatever. $30.
All right. It's Thursday, right?
Yes, sir. Start the pre-roll.
Thank you. Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick. Thanks for tuning in. It's 2 p.m. in Chi-Town. We have an hour left until the close. It's kind of a quiet session considering everything we've been through lately, but it certainly could be calm in the middle of a storm, before the storm. However you want to look at it, volatility is obviously on everybody's mind. I think the quote of the week came from our own Brent Kochuba, who said, we're all oil derivatives traders now, a sentiment that was echoed in some of the conversations I had here this morning with traders in Chicago, talking about the key line in the sand breaking in the S&P 500, which was 6,600 roughly. We've been just plowing through support to the downside, unfortunately, and finding support for VIX higher and higher. A regime just stuck at 25. Elevated volatility certainly gives you lots of opportunity as an options trader, which is what we spend most of the time here talking about. Premiums are juicy, but fading vol has been kind of dicey too. So it depends on where you do it, how you do it, and when. Volatility at 24 is now right at the midpoint of a range we've been in, pretty much between 20 and 28 throughout the month of March. Just draw a little box around that, and you can see how this regime has indeed moved up really since the beginning of the month. So market is figuring out what to do next. The S&P technicals are struggling to hold 6,600, which dates back to the end of last year. Really, this is a level that must hold, and it is fraying basically around the edges here. We first got to 6,600 in September last year. We saw that we dipped below it a few times, but that's the reason why I've got the line there, is because in the past they've tried to break us down and bulls were able to support the market. WTI, to the point of us all being crude traders at this point, is giving some relief at 94 bucks, but obviously a trend there too, technically, that you probably don't really want to toy with too much. WTI dips have generally been bought, and no matter what the president says about the war being short or it's over or we won, price is king. And of course, the monarchy has not existed since 1770 something here. Thanks G-Dub for giving us the nod on that one. But price is king, and the price for crude oil at 94 bucks basically tells us the market's not buying any of the short-term talk. However, over time, I hope that crude oil will have some degree of mean reversion lower, because one thing that arguably the Trump crew does like to do is pump oil. So the U.S. being the number one producer now should at some point come to the rescue. I don't see why we don't start pulling more barrels out of the reserves or wherever we can find them out of the ground too. After all, 100 bucks, according to Billy Bob Thornton, Landman. It's kind of a confusing point for oil. It might hurt the consumer, but it certainly is good for the producers. My risk radar remains yellow across the board until 66 breaks. I have that yellow for stocks. Everything else generally looks range bound. If you were trying to spin a story about crypto and Bitcoin coming to the rescue as some sort of like hedge against all this madness, how many times I've said it, do not buy into that madness. That's not what drives Bitcoin. What drives Bitcoin is risk or risk off. And even risk last year was not able to push Bitcoin higher. So it was strong over the last couple of weeks, but I pointed out, look at IGV, for example. Look at cloud. Generally tech-centered stuff that had been beaten down was stabilizing. And so Bitcoin deserves some credit for being stable, but I don't think it's going to be your get-out-of-jail-free card by any means at this point. Lastly, finally, the 10-year at 4.2%. The reason that's still yellow on my risk radar is because it has not punched through the 4.3. I mean, look at all this. Dollar, too. Big rejection for the dollar at 100. So just tons of range back and forth with volatility still elevated. Let's bring in Mr. Brent Kochuba from SpotGamma. Brent, thanks for dialing us while you've been on the road. Yesterday, you were doing the True Lies drive from the Florida Keys, and my Zoom picked up some of your family chatter in the recap. What show are your kids, the superhero show? What's your guy? You guys Marvel family, or what was that?
They jump all around to stuff that I don't even know, and as long as it's appropriate, I'll let them go. So I couldn't even tell you what it is.
Yeah, the Zoom picked up some family chatter that was pretty funny in my recap. But hey, you had the quote of the week, basically.
Big Magic Spoon people over here.
Oh, Magic Spoon. Okay, yeah, I don't know what that is. Your quote of the week is that we're all basically oil derivatives traders. So with oil down 1.6%, stock market able to come back here, possibly hold 6,600?
Yeah, the thing about this that's tricky, Oliver, is that volatility is rich. And I think if you talk to Noel and some of these other vol guys, they'll say as much, right? But the problem is, for me, is that volatility or that vol is rich relative to very quiet realized vol, meaning the market is not moving. So current VIX is rich, for example, relative to how much the market's moving. But the market's only moving about 70 basis points a day, which is what the realized vol is, right? So the problem is that if at some point we actually have a mild risk-off move in the market, a 2-3% down move in the S&P, then suddenly I think that vol is going to spike and spike sharply. And until the Iran situation is somehow resolved, or at least it seems like there's a path out of this thing, we all have to respect the fact that we're one headline away from stuff getting really pretty ugly. And so the chain here is higher oil is higher rates. That starts to bring in credit issues. That starts to slow the economy down. That starts to throw a whole bunch of other things under question, right? So the risks are real, but but they're known unknowns, meaning we know the Iran situation is ugly. We know the chain reaction of that stuff, but we don't know when and how it will resolve. So how do you sit here and short vol in any type of meaningful way? Now, no sophisticated guys know how to do it, but for the rest of us sitting around here, I can't sell puts or sell VIX calls. I don't even necessarily want to get long equities until I know there is a decent opportunity for a bottom to be in this market. And again, I also don't want to short expensive vol, which is based on realized vol at 12. If expensive vol is based on realized vol being, 3, 4, 5% equity moves, then okay, that's a little bit of a different story. But right now, we're only rich to very quiet markets. The vol is only rich to very quiet markets. And to me, there's a lot of risk embedded in that.
Okay. The idea of VIX overpricing moves certainly has been a really important theme because it does kind of push for those collection harvesting of, premium, selling it, taking it, taking in the speculators. But then yesterday, the market closed towards VIX as we slipped. VIX was 24 or whatever, right at a 1.5% expected move, while S&Ps were only down 50 bips, and then we closed to VIX. More days like that, and we might be getting the kind of freak out that you've talked about where VIX just says, screw it, like we got a dump here. And I do wonder, it feels like, we need good news to prevent that from happening, I think, Brent, where normally the market needs bad news to disrupt the uptrend. I think as long as we're under 6,600 in the camp, that we need good news or else that moment will come.
And I think right now you can make an argument that options expiration now is a stabilizer in the short term. The VIX opened yesterday at 2-week lows or post-Iran lows, right? At the cash open when those VIX contracts settled, then suddenly vol moved up from there, right? And equity sold down, to your point, from around 6,750 in the morning to about 6,600. OPEX tomorrow is put heavy. It's a big options expiration, not the biggest ever, but it's a very large options expiration. There is net put flow that's going to be sold tomorrow, and I think that's a mild buoy for markets. Normally, I'd be looking for a much more substantial rally out of a situation like this. But because of this Iran situation and the known unknown, you can't sit there and short vol in any kind of meaningful way, until that's resolved, right? So what that means is that we have some short-term stability. I would think this maybe into tomorrow, maybe into Monday, right? But we have to respect the fact that the options expiration is maybe a buoy for markets. Once that's gone, right? Once we remove that stabilizing effect of OPEX, who's to say that we don't have a bigger downside? And to that point, if you look at negative gamma, it builds all the way down now into 6250. And so we keep seeing this lower low positioning come into this market. Right? It keeps pushing down. Now, the JP Morgan collar trade, everyone's going to be talking about that. That's at 64.75. That's a major level into 331 expiration. But I think we still have this opportunity here with OPEX removing for this big realized move down that would make vol really spike, right? That would turn into one of these Wikipedia events, where you see it in Wikipedia because it's a big vol spike that we have to track. So, that is the risk that I see here. Now, at the same time, Oliver, and this is really tricky because I'm saying the market could slide down, and that's a major risk. And I think that is the risk we have to respect. If there is one positive headline, call skew is very low right now. You could see traders slam put options, suddenly have to pile into calls, and then you could see this massive rip to the upside. So it's a really tricky situation for traders here where I think you have to be keen on this. The moment that we have some type of idea when this will all resolve, then it's going to be a major risk on move in that type of environment, right?
Brent, to that point, a Wikipedia event. To respond to chat, two things that stand out to me in chat. Number one is I think people like you without the beard. But they want to know why. I think it's because you were in Florida and it was a little bit too hot. Second thing is that someone says, feels a lot like Feb 2020. I'm going to take the other side of that, and I'm going to bring some VIX charts behind it here. Panning back over to my TOS platform real quick. Here's what VIX looked like in the run-up in 2020. There were a couple weeks of VIX nearing 20, but it never got above it. It was slow, and then it was explosive. And I myself generally remained kind of a fader of the COVID fear until we started breaking down technically, and that was basically mid-Feb. So at about 5% off the highs, the technicals broke, and that was when I personally said, okay, this thing could get nasty. So I missed a little bit of it, but then ultimately you had the explosive move very fast. This feels quite distinctly different, because sliding it over to the weekly chart for VIX now, VIX weekly chart has been rising for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 weeks here. So my kind of thought here is that if we do get a explosion, I don't think it goes to COVID levels. I don't think this is that. Few things are a global pandemic, but it's already different in nature because it's kind of slow burning already. Tell me your thought.
Yeah, I can't, look, VIX is rich relative to the fact that the S&P is really not moving very much. And so there's no two ways to slice that. But if you think about the more modern market, if you remember last August, for example, Oliver, when we had VIX print 60 just off of liquidity disappearing in the carry trade, allegedly in Korea, kind of unwinding or some sloppiness there, right? And it was like, bam, suddenly vol just went absolutely bananas. And so I think that what is happening here is that we are being lulled to sleep a little bit and saying, well, because the VIX is at 2025 and it hasn't gone higher, it's unlikely to happen. And so the concern here is that the shock absorber of OPEX is removed, and we're one sort of little tweak away from suddenly liquidity evaporating, which is very common to do, and then suddenly you see a big jump in realized vol that brings a big jump in vol itself, right? And to this point, you asked today about zero DT volumes, right? They're typically around 65% now in the SPX. They reduced to 58% yesterday. Why? Because the zero DT people disappear when known unknowns and real risk are produced in the market. And zero DT is such a source of liquidity in this current market. And so I just think that
so that's on
you
net
had
bearish,
a situation,
right, Brent? Because that's kind of safety net. Those zero DT flows are generally a positive safety net. So if those are dropping a little bit, that's not great. Am I wrong?
Right. Right. You can't hedge the oil-Iran situation or credit risk with zero DT options. You can't do it. So you have to focus more on longer dated options. The other thing I would note, Oliver, if you look back at last February, right? Last February to March, you can even scroll back on your VIX chart right there.
Okay.
We moved down from February options expiration into March expiration, right? This was during all that tariff
25.
drama. Exactly right.
Tariff
and then
drama,
all of a sudden, look at 331, right? 331 is when the JP Morgan collar trade expired. That was at 55.65. We pinned that level into 331, and then it was like the cap came off. Now, you needed some tweets from Trump to really get things spicy, but if you look at that chart, it's like somebody lifted the lid off the thing, right? It was boiling up into that options expiration, and then we just sort of evaporated or escaped, right? It was escape velocity to the upside. We had this very illiquid, crashy type environment. And I think that, again, is the risk here. We knew that tariffs could get ugly last February, March, right? It was not a secret, but we didn't understand until it happened, just how risky it could be, the chain reaction of events, that type of stuff. The other thing about this is that oil vol is screaming. Oliver, if you look at gold, man, gold just absolutely just puked today, like out of nowhere, right? So the cross asset vol is very high. That's another area of contagion for this market. I'm not saying it has to. I'm just saying you can look around and point at all these risks and say, these are real risks, right? It's not that it's a very quiet day and I think a storm's going to manifest out of nowhere. It's just you have to respect this risk. Doesn't mean you have to trade it. It just means maybe you want to sit on your hands because what is happening is indicative of more volatility in other asset classes.
Yeah, it's starting
positions
to
being
spill
removed.
over.
Exactly. And so again, maybe you don't want to short it. Puts are relatively expensive. That's totally fair. But to think that we're in this position where we can short vol because the risks are behind us and we haven't had a big jump yet, I think is a dangerous outlook on the market.
Brent, what about just kind of shifting like my kind of bullish skewed iron condor down a bit? I mean, I still do generally, look, we're trying to go positive here. I mean, but I still have this kind of AI tech bull inside me. This is the last point because we got a few folks waiting on the Zoom. But just real quick, Brent, what about that idea of just kind of shifting down the range bet?
I think that totally makes
kind of
sense.
the opposite of what or tell me what you think.
I think that totally makes sense. Call skew is at 3 percentile right now. What does that mean? Calls are cheaper on a skew basis than they've been all year in single stocks and index. But the overall level of vol is still high, right, Oliver? So what happens if we get any type of a deal? VIX collapses, vol comes down, and the market rallies probably 2 or 3%, probably right back into 6,800, right? And I think that could happen quickly. And that's the tricky part here. So I like call flies in this situation, short dated, 2-3 days out. You just keep rolling into them. They're very, very cheap, right? You want to use the call fly because if vol collapses, you want to offset some of that risk. But I think that's a really nice way to play a very fast, very sharp rally in this market, which could come. This is the dual-sided risk we have, where we have left tail risk and right tail risk, which makes it cheap, or which makes it tricky. So I don't want to own stock in this situation, but I love owning options here. Call flies and put flies, playing volatility both to the upside and downside. You can make a great case for either. I don't know, but you can very efficiently position for either a bullish or bearish outcome.
And they both can have some overlap,
right
right? In that the kind of middle point of their range for those flies, a bullish or a bearish, can share some common ground.
I think that's totally right. And so if you're going to take away something from here, short dated call flies for rallying to 60, 100 make a lot of sense. You could do it for pretty reasonable prices. After 331 options expiration, I think the opportunity for a really kind of nasty move, if this Iran situation is not resolved, I think that risk greatly increases as we move into the end of the month.
Good stuff. All right, nice. Love a little action. Some ideas there, Brent. Thanks for tuning in and on the road. Appreciate that. I like the no beard. I took mine down too. It's starting to get warm.
The beard's a little too popular, man. I always got to go counter trend. Trading in beards.
We go back to VIX 40. I don't know. It might get hairy. Thanks, Brent.
We'll grow the beard back for VIX 40.
You the man. Good stuff. All right, from options into potential squeeze plays. I think time to maybe look at a couple stock specifics here as we do get the market finding some degree of specificity when it comes to earnings. We did see Micron move around on earnings. But Geoff Garbacz at Mark Rebellion's got some interesting ones. Geoff, what's going on? Good to see you.
Hey, how are you?
Pretty good. I like a few ideas that you got here in tech, and then you got kind of a, kind of a out there sort of consumer play. Maybe, but first, you watch a measure that looks at, you call it the BARF metric, is that right? I think that was kind of interesting to start with, given what Brent was just saying.
The Erlanger Big BARF indicator.
The big BARF indicator. So is that what we're talking about? The potential for the market to just puke?
Yeah, it's the relationship of the VIX to the S&P.
Okay.
So the way it works is if the S&P is going up and the VIX is going down, that's good. So basically the red line is the big BARF. And where I've circled it is when we've been below zero, like we are now.
Okay.
And so you'll see that the arrows up above in the S&P kind of correlate with the S&P dropping. So we're vulnerable right now. This is a monthly chart. We do a weekly and also a daily. Those are well negative, but the monthly's potentially about to crack. And the last time it cracked was in 22 when we had that bad year. We basically our last bear market, if you will.
I see it. Yeah, down here, right? It's sustained down there during the interest rate bear market. So usually, if it goes below, it comes back pretty soon, unless you're going to start a trend to the downside.
Well, remember, each of those boxes is a whole entire year. Each box equals a year. So we only get breaks we haven't had a break since 22, really. Yeah. We came back up in 23. We touched it last year in the sell-off in February into April, and we're there again right now.
Okay. So VIX and the S&P 500.
So if the VIX is going up and the S&P was going down, then this thing would drop really well. But let's say the VIX was going up and the S&P was going up as well, it wouldn't drop as much.
Okay.
So it's those relationships, and it's done a good job. It really has. So we're just at a point where we're either going to break it or we're not.
Okay. Hey, speaking of drop it down, any chance you could drop that camera down there so I can see your handsome face, Geoff? There we go.
Oh, there you go.
Yeah.
Let's see.
Hey, there he is. There's a man with a beard. Someone who didn't shave it. Yeah, nice.
Yeah, I heard you talking about beards.
All right, so look, VIX has been fairly elevated. Stocks have been range bound. This thing suggests that the way those two close, perhaps, well, it doesn't, I don't know, does it suggest, Geoff, or does it just tell us if it's happening, and then we got to be heads up?
It tells us the odds are increasing for it to happen.
Okay.
That's what it's saying. And it's already broken the weekly, and it's already broken the daily pretty good. So I just thought I'd show the monthly, because the monthly is like on the brink of doing it,
Yeah. All right.
And
any idea where, look, does it tell us anything about price magnitude or just the overall trend shifting to a negative one in price?
Well, yeah, it definitely is arguing for you can make money on the short side, and we're going to drop to maybe at probably 600. If this thing breaks pretty good, SPY will go to 600, and SPY will go to S&P 500 will go to 6,000.
Okay. That would be pretty juicy, but it would take us back to where we were pre-tariff sell-off. For a little context,
here's
S&P here.
the problem. Mm-hmm. If you look at that chart of ASO that I sent over to you,
okay,
you'll see that Academy Sports doesn't have anyone short right now. And so, therefore, as the technicals drop, it becomes what we call a long squeeze. And this is like a term you're going to end up loving. It's basically when the stock is weak, no one is short, and the longs have to sell, and then there's no shorts covering out. So it just keeps dropping and dropping and dropping. And you're like, what is going on here? Why is this stock dropping? Well, it's simple. It's like Micron today is a great example of that. No one was short Micron. So you know what's happening today?
Yeah.
Like people want to sell Micron than want to buy it. That's why it's lower. Even though like it beat on earnings, it gave good guidance, it increased its dividends, blah, 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 but still, nonetheless, it's dropping.
Okay.
So our long squeeze list since 2002 we produced it, it's double the return of the S&P.
Okay. So you think this becomes
short,
a long squeeze?
Yeah, a long squeeze.
All right. ASO, Academy Sports. It hadn't really been on my radar, but I love it. You're finding gems. I like that.
It's a name that there's no shorts really in it. And all the longs have gotten into it. And now it's starting to break down because the economy's not as good right now. The economy's struggling. All of a sudden, you got to pay an extra $1 a gallon for gas, and you're not going to go buy the Nikes at Academy Sports. Right. You're going to Walmart to buy some sneakers,
Yeah, well, where I grew up, we were going to Walmart anyway. Pay less is where I was going.
Pay less.
So.
Pay less. Yeah.
Hey, Geoff, you got one in Dell, too. Sticking with stock specifics.
Dell is
ripped on earnings.
Dell is the other side. It's a short squeeze. The shorts have just been betting against it as it's gone higher, and now they're caught. And they blew it out on earnings, and they haven't covered yet. So this name could keep going,
Okay.
The upside.
I mean, today up 5% almost with the market flat.
Yeah. The shorts are feeling it. They know they got to cover. And, look what just happened. That little pop we got at like half an hour ago is like, boom.
Yeah.
If you're a short guy, all of a sudden you're like, oh, maybe I need to cover this,
Okay. So the short squeeze on Dell pushes price higher. The long squeeze as you put it on ASO likely to keep that one compressed.
Correct. Yeah, it'll be compressed for a while.
And the BARF indicator, we look to see if it turns south to get us to S&P 6,000. Which obviously would be a doozy. That would be a doozy, but a lot of people in chat think it's going to happen.
I don't know. It's going to be very interesting to see how all this plays itself out. The other thing I told you last week that I'm watching still is semiconductors, because there's so many semiconductors that have no one short, and that same type of thing. Like Micron is what happened. That was a good example of one, and we only have a couple names that are really heavily shorted in semiconductors right now. So people continue to start covering software, and they go in short. Semis could get pounded on here a little bit.
That would not be good for the market, certainly. Geoff, I like the perspective. Interesting names and unique charts. Appreciate it. Thanks, Geoff.
Thanks a lot. See you later.
You got it. Geoff Garbacz, Market Rebellion. All right, 2-minute innovator buffer break, maybe 2.5, and then it's the Cboe ETP, exchange traded profile. We're going to look out on the horizon for some safety plays, but also maybe some sector-specific stuff. The Horizon Investments team is going to join. Got Clark Allen waiting on the line. It's going to be a good conversation. SFTY, a ticker we're going to check out. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show here. S&P 500 dipped a little bit there, got some noise behind me, and we slipped. 6610 is where we're at right now as the market tries to hold on to that 6600. We had a nice little ramp basically as soon as we started the show, but we are losing it a tad. There's the intraday chart as the market comes back down. Let's do a little diversion though. Let's talk some ETPs. It's time for the Cboe exchange traded profile, and I think we got some good ones in here today as well, because options are going to be a primary force, finding some protection at a time when people are quite worried about where things could go and if volatility could get even worse. Clark Allen joins me, head of product at Horizon. Clark, great to have you on the show. Thanks for coming on Chicago Future Finance.
Great to be on here. Thanks for having me, Oliver.
Appreciate that very much. I'm going to go right into it with some of your guys' tickers in your funds, because on a day like today, I do think people are considering what the downside could be. You guys have one of the best tickers in the market, maybe, SFTY Safety. How much you guys pay for that bad boy? That's a good ticker.
Oliver, we pulled that one off. That one was a great one to get secured. So it was free, as all of them are, but it was great to get.
Okay, nice. So SFTY, I mean, tell me about it. Obviously, the theme here today, and I think really the last week, is should folks be worried that things are going to get worse, that VIX creep could turn into VIX spike? How does this factor into that decision-making process and how they should be prepared?
Yeah, absolutely. SFTY is our risk management strategy. We've got a number of these. We as a firm have been known as centered on risk management, in particular tactical risk management. So SFTY is a strategy built around a core, active, sort of high-quality stock basket, and it's got some tactical risk management. So as vol picks up, as losses start to accumulate in the portfolio, this is designed to protect folks. We talk to a lot of advisors, a lot of end clients that say, hey, I want to be exposed to the market, but what if? What if I need money? What if we go into a 2008 scenario? ETFs like SFTY are built for risk management, or are built to give upside participation when it's there, but to really tactically protect the portfolio when catastrophic markets happen.
Tell me about the tactical side. You guys have a proprietary risk assist strategy. Tell me about what that is. You're buying puts, selling calls, doing a little bit of both?
Yeah, in this particular strategy, this tactical risk management strategy for SFTY, we're utilizing a vol forecasting methodology. We're looking at sort of the market movements, and we're actually de-risking the portfolio. So in this particular strategy, we're not using any sort of options for hedging. Those are some other strategies that we do have, but in particular for SFTY, what we're doing is we're tactically selling equities and buying into short-term treasuries as vol picks up, and losses start to accumulate in the market.
Okay. How do you go about that? Where do you figure out how to start? Can you give us a little of the secret sauce? How does it know which parts to take off? Is it like a technical, these things have the worst momentum, let's get out of there?
Yeah, so it's broad-based. And so what we found for clients is what they really care about, especially as they get towards retirement, isn't necessarily vol or Sharpe ratio or even deltas and gammas like you and I may want to talk about. They really just care about what's the loss in my portfolio. So one of the biggest drivers for SFTY is what are the losses being realized in the portfolio? And then obviously you want to take into account vol dynamics and other market sort of inputs. But the biggest driver is what are the losses? And as they begin to pick up, we're going to begin to de-risk. And it's not a 100 to 0. It's kind of like an on-off switch where we'll slowly de-risk in sort of 10% increments. making sure, right, the biggest risk, right, insurance isn't free. Even with a tactical risk management, put spreads aren't free either. And so protection costs something, and that cost typically comes when you begin to move out. Right, a 2020 big snapback, you're going to probably lag in the early parts of that snapback. But the benefit you got was you got a lot less volatility, and your drawdown and your loss, which is what a client really cares about, was a lot less than the broader market.
Okay, I see. So I know you're hitting on some of that, but I guess in kind of from the competitive product standpoint, how does it compete, or what's kind of the pitch to say, okay, you want to do it this way instead of, because a lot of people that go, all right, hey, I don't know if I want to be in treasuries as a safety. I don't know if I want to be in bonds as a safety. Do you disagree with that idea?
Yeah, I would say with treasuries or short-term treasuries, especially when they're yielding 4 and 5%, I'd say that's probably a good place to park your capital. I do hear what you're saying in broad-based bonds. From a competitor landscape, right, you could just buy 60-40, but folks still want upside participation because we've been through some pretty nice rallies more recently. And then as it relates to other competitors on the option side, we have competitive strategies, some of our own as well as in the industry that do protection through options-based. It's just going to give you a more constant sort of protection, which is going to cost you more over time. The idea with SFTY is when we're in an up market, when we're rallying through, let's call it last year, let's just participate in all those gains. And so let's not actually do any de-risking. Let's not do any tactical risk management. And as we grow into a sort of a choppy period, as we go into a drawdown, let's then put on that insurance or put on that protection, if you will.
Okay. The other thing is, I guess, thinking about kind of, not to harp on the treasury side too much, but if we've got this kind of inflation backdrop fear, is there an element of volatility you got to hedge your hedge in terms of having bonds in there at all? Or what about cash? How does that kind of factor in? Is there a point where you hit some certain critical level and say, all right, maybe we just put money on, in cash?
Yeah, when I say treasuries, I mean short-term treasuries, Oliver. So
okay,
we're not looking to take any duration risk.
Okay.
Yeah, we don't want any duration risk in the portfolio because as we saw with 2022, it could be a total mismatch of sort of correlations. And so we go straight to short-term treasuries, 1 to 3. We can call that cash, but we want some yield in the portfolio. So just trying to get that protection. And yeah, vol is a big component because vol changes quickly. As we know, VIX spikes, vol goes down, but vol can fall just as fast as it goes up. VIX is just a measure of those moves, right? And so as vol begins to sort of come back down from those huge levels of peaks, we want to also be responsive to that to make sure you get reinvested and take those hedges off and take that protection off.
All right. Geoff Goodlock might have a counterpoint on the 1 to 3 being safe as cash, effective, but I'll let him do the arguing for that. Tell me, Clark, case well made. The other one that I thought was kind of interesting is stocks, STOX. Tell me about how this kind of plays in. Obviously, it seems like these are kind of versions of a core equity holding, but this one seeks capital appreciation as well. So I'm guessing you don't want to limit the upside too much on this, right?
Yeah, so this is kind of, I'd call it a brother in a sense that this one is using much of the same underlying active selection, but instead of taking away risk in a drawdown, what we're trying to do is just target some risk. Right? If you were to look at finance theory and say, what's the most optimal portfolio, right? Run efficient frontier, talk to advisors and clients, they really don't care. But if I want to select the best stocks or you want to select the best stocks, we as financial professionals would say, well, that's typically going to be a defensive portfolio because that's how you're going to optimize your efficient frontier. Well, a client or an advisor says, I still want to participate in market gains. I don't really care about this number you call alpha. And so what we do here is we select what we believe to be high alpha strategy, stock selection using a systematic process. Because it's defensive in nature, runs a little bit light on the beta, we then take put spreads and sell put spreads to basically juice that risk up. Make sure that we get market participation of around 1. So that way it can be used in a financial plan as a core holding with some embedded alpha through selection. Also minimizes tracking error from a risk perspective because for a client that's not looking for protection with SFTY, they really just want to participate in gains. But we as professionals also want to give them some stock selection and some alpha opportunity as well.
And then the selling of the put side too. I mean, that's a little extra on top, right? I mean, some income too along the way.
Yeah, absolutely. So when you sell those put spreads, we've seen lots of periods of times we sell them on a short-term basis, and so there's many periods of time where they're really additive from a return perspective, not just a risk. Right, they add not just to get the beta up, but they can also add some alpha potentially over periods of time. That mix of we found to be really attractive. And from a portfolio theory perspective, again, select that optimal portfolio and then just get the risk to the point that you want it. Gives you the highest alpha opportunity.
All right. Just kind of from a portfolio construction standpoint, and because you guys, it's interesting about your portfolio, I think, of offerings is that you kind of have different versions of, to some degree, kind of, accomplishing similar things, but from a different perspective. Everybody kind of has their own preference. Some people like to use options if they want income. Some people just like a good old-fashioned dividend. That brings me to the last one here, DIVN. If I'm an advisor trying to, get an income component, how do I decide between just going for dividends versus generating income through security sales or derivative exposure?
Yeah, it's a great question. And I would say what we found actually more recently is S&P 500 dividend yields are very, very small. And so when you go to put on a dividend portfolio, some of the biggest dividend strategies in the marketplace, they can carry a lot of active risk and what we call tracking error, right? Because you got to overweight a bunch of energy stocks of other things. As we know, that can be good and that can also be really bad. And so what we've done here is we said, how do we tilt in to dividend payers? Well, you can't get 6% yields or 5% yields doing that. And so on top of that core dividend portfolio, that's a high quality dividend portfolio, we sell calls. Short-term calls, which basically juices that distribution yield up and gets you around that 5 to 6% place, which we think is really attractive from an end perspective because you're not taking a bunch of sector bets to get that yield, but you're being able to distribute yield that's quite attractive. In addition, right, we're tilting into high dividend payers, so you do get high-quality sort of dividend value exposure, but it's nothing with these massive sector exposures that some folks doing in the industry.
All right. Looks kind of good right now, the sector exposure that I just pulled up here. Where'd I go? I had it. Nice little chunk of Chevron in there for oil ripping. I don't hate that right now. Exxon too. I imagine that this is might be getting some traction, some interest with oil at $100.
Absolutely. We see folks, especially in the retirement stage, folks using a lot of dividend payers, and this has been a very attractive exposure for them.
Hey, just like hedging AI disruption by investing in AI, maybe you hedge crude oil disruption in the economy through dividends and payouts from crude oil pumpers. What do you think? Not a bad idea, Clark?
Not a bad idea.
All right, great stuff. Clark, thank you very much. Appreciate your time. Head of product of Horizon. Interesting DIVN, STOX, and SFTY. Appreciate you very much. Thanks for your time.
Appreciate it. Thank you.
You got it. Clark Allen, head of product at Horizon. Here's your Cboe Exchange Traded profile. We're going to go into the bell with some stock specifics, some trade ideas. Charlie Moon, Prosper Trading, going to jump on with me as we try to end on a good note, but struggling a little bit right now. 6,600, desperately trying to hold that line, but it's a little weak. The VIX right now sitting at 24.3. It's basically been there all day. Be right back. 19 minutes left. Got at least 10 with Charlie next.
volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, we're now 15 points away from an even close on the session. Stock's trying, working. We're going to try and find some groups, some categories, maybe some trades here in the next 10 minutes. Charles Moon, Prosper Trading Academy, joining me. Click the QR code, boom, right there. First of all, Charlie, Scott can't be sending us videos on the slopes like when we're about to do a hit, man. I'm really jealous and distracted now.
You know, he's just hanging out at that bar we were all hanging out at the Four Seasons.
Bachelor's Gulch.
Yeah. He's having a good old time today.
Well, they closed down Tahoe apparently because it was too warm, but it looks like it's still going pretty strong. Oh, I guess it is warm. He's skiing shirtless.
Oh yeah, he's definitely all about it. I mean, listen, I don't even know how there's snow out there. It's 80 degrees out where I live, and I'm only an hour and a half away from him. I'm in the Denver area. He's in the mountains, so. And I actually texted him earlier if there was even snow, and he's like, yeah, I'll figure it out.
Well, I'll have to get his professional thoughts. I mean, I know he's going to say no, but I'm considering, so I'm going to be out there next week, and I figure it's time for me to try the snowboard, but I don't know if the thinner snow is going to be good for that, because I'm going to need all the help I can to stay up. Charlie, tell me about, yeah, I know. What's your vote on that, on the snowboard?
The answer is no, not now.
Okay, let's talk, since we're talking solar arrays and sun, let's go into, I mean, when I think solar, I look at TAN. I know that you were looking at this group. Why, Charlie? What's going on?
Well, you know, in comparison, if you think about it, this is a sector historically that coincides with the rise of crude. When the rise of crude goes, this sector comes to life. Now, the most prominent name in this sector is First Solar. They've really struggled a bit. They've been kind of floored since earnings and haven't really been able to lift. But there's 2 names of reference that is getting really, really interesting, and one is Enphase, ENPH. They're starting to really kind of cross up and kind of, you know, maintain their gains. They basically came down to try and fill the gap after they gapped up on earnings, and they've been in a bit of recovery since that moment. And another one to look at is Solar Edge, SEDG. These two stocks were left for dead. They thought they were going to crater out, once the green initiative or the subsidies were taken away. Once this new administration came in, they basically wiped out that kind of previous administration's, green push, so to speak, and a lot of the subsidies went away. They thought that these names were going to get crushed. These are highly shorted names. They have pretty big short floats. More importantly, if we look at Solar Edge, for example, they've come to life. They've jumped up $10 in the last week, going from $36 to $46.
It's a jackknife. Is there anything to be said about oil surging, so solar looks nice, or am I reaching there?
No, and that's exactly what it is, and this is, again, going back historically, over the last decade, it just has always had this coinciding factor. We just haven't seen it as much yet. And this is also similar to why I'm looking at EV names a little bit more, right? If the longer that crude anchors at $90, $100, and people are looking at, the gas pumps being from 380 to 480, and most notably, if you saw the spike in diesel, imagine owning a vehicle that needs diesel. This is where a lot of people start looking at EVs and start getting intrigued. Now, we haven't seen any kind of love for Tesla, but we saw a big spike today in Rivian with that Uber news and the Uber investment. And more importantly, Lucid is now trying to pivot, and they're now trying to make a little bit of noise. And I think Lucid, LCID, this is a stock that's getting interesting because if they could kind of poke up through this like $11, $12 range, we may see just out of nowhere a run that just kind of catches the market by surprise all the way up to $17. They've talked about autonomy as well. This is kind of like on the back burner. There's a lot of interest. They have a lot of money back from them by the Saudi group as well. But, it just seems like this sector is not getting enough attention, at least for the time being, because maybe people are speculating, just like Jerome Powell said yesterday, that this jump in crude may be just a one-off, right? In terms of, Jerome's like, well, it might be just a one-off in terms of inflation. Well, what if...
Story, baby.
What if, listen, what happens if it anchors? What happens if all of a sudden
chart looks like it's anchoring at $94.
And it doesn't want to go down. It only wants to go up. And again, I don't see how we could retrace back to 70 unless, one, we obviously end this war with Iran, or two, if this persists and, like I said, another energy field gets hit, or another tanker gets attacked at the Strait of Hormuz. No matter what, if the U.S. can't protect every tanker ship that's coming out there, even though it's a small supply in comparison to the rest of the world, it's going to have a really massive impact on the pricing of spot, which is crude futures. And again, we've seen how volatile and how willing this spot price is willing to go up. There's also a big divergence. They talk about pricing in Asia, being very different than the pricing in the United States. I believe in Asia, crude or Brent oil hit like $150 a barrel, and we were just tickling on $100. So there's like this really big global imbalance in terms of pricing. And again, if that stays anchored at the upper portion of the range instead of reverting back down to the lows, there's a significant amount of implications from a negative impact on our economy from an inflationary standpoint. Jerome Powell was talking about how stagflation isn't a thing. Well, it could end up becoming a thing very, very quickly, maybe even more quickly than they would anticipate. And then in turn, this is where a lot of guys may start gravitating towards EVs and solar plays.
We know Powell didn't want to cut to begin with.
Right.
Political pressure, all that stuff. So I like the study up. By the way, I was looking at the chart of XOM. I was looking at the chart of CRAK, crack, one of my favorites, the oil refiners. Those charts look pretty great too. I do wonder if these are kind of two sides of the same coin to hedge this oil move, Charlie, is to pump up your energy holdings. Because one of the solutions, of course, could be all the U.S. companies start drilling, baby, drilling even more.
Yeah.
And I do think I also though like the chart in particular. Well, Solar Edge is action, but Lucid, that was the one. Finding support. I like the EV trades. I'm going to be getting driven around next week in Colorado by a beauty in an EV car. So, you can go anywhere with them now.
Yeah, I mean, I grabbed one. I grabbed the BMW iX just a few weeks ago.
So
Timing
rad.
has been great, and I got to tell
Come
you,
up, you can drive me around too.
no, and I'm down. I'm down. But that's the whole thing. Now that I've actually purchased an EV, I have a hard time envisioning going back to a gas vehicle.
Yeah.
It's a very different experience.
It's a little tricky at first. Like I was kind of worried we were going to get stranded a few times, but once you figure out, and she's driving a Mustang, the new Mach-E.
Yeah.
And you got to get the right charger. There's a learning curve to it, but I think that's your point. Is once you get to the learning curve through, then I mean it's nice. You know exactly what you're going to pay. Basically, you figure out your electricity rate or whatever. It's not bad. And most places are pretty amenable to it now. So, yeah, I mean, whether it's Lucid, whether it's, Tesla, though that stock is more kind of the MAGS category. It's breaking down a little bit.
Yeah.
Tesla, not the EV trade, too much big tech connection?
Again, it's really interesting because there's times where Tesla looks like it wants to go up. They've been kind of getting squeezed over the last few days. There's been a lot of downward pressure into the 200-day moving average. It's been sharply rejected at these faster EMAs on the daily chart. And it's just been kind of bouncing back and forth. Well, today, based on the open, it just gapped down pretty hard, and it's been pretty much a gap and go day. And anytime, a stock usually opens down big, there's usually some sort of reversion. Not for 1 second today. Tesla, outside of that just momentary pop in the markets, have basically been staying in that lower, 1/4 of their daily range and just been hugging it. They haven't really been trending down, but they also haven't been lifting, and that's been a stark difference when you look at names like have these days where they just totally segregate from what has been really consistent. One of the things that stood out to me today is at the open, residual attack by Iran onto 9 different countries. They're just totally willing to go against anybody and anybody. If their sovereignty is being threatened, and like I said, it just seems like the United States and Israel kind of underestimated the will of the leadership in Iran, and they're just really just kind of hunkering down, and they're just willing to just fight until the very, very end. And like I said, I don't know how that's going to bode for commodities in the near future, but it sure doesn't sound bearish.
Chart, I mean, to your point, LNG, that's a huge move. That move does not say ending soon. But I think that you still don't have to quite panic yet, particularly, I like the idea of adding things that could potentially benefit rather than selling and destroying my portfolio of longs that I might like long term. So you can dabble in the solar stuff. You gave us some names. You can dabble in some of the oil related stuff to add on if you got free cash flow. I like that approach. Charlie, thank you very much, sir.
Thank you for having me, brother.
Fun stuff, good stuff. Charlie Moon, Prosper Trading Academy, good eyes, good ideas. And at the close here, going to take it down to the end bell until you hear it ring. We're at 66.07 spot 6. Market has just been sideways. One last look at the chart there. I like that. The fact that we weren't able to break it. I mean, there you go. Look at that. Just holding right on that line at 6,600. Thanks for tuning in. That's it. It's Thursday, so I'm out of here. Catch me on TikTok at OJRenick/Stay Solvent. Try to do the same tomorrow for options expiry. Good luck. And I will see you next week, Monday, by the way.